The largest stock market allocation in history has just been recorded. Yes, we're living it. The markets are surging, with everyone piling in, and we've hit a historic high above 6,000. So, what's next? What are the options flow in some of the world's top stocks, and US Treasuries telling us about the market's direction? Are we climbing the wall of worry? Sentiment reports show plenty of concern out there. Hi, I'm K2, and if you love markets like we do, make sure to like, subscribe, and join us as we break down stocks, commodities, and cryptos in this special weekend edition. Trust me, you don't want to miss this. Let's dive into the data right now. The upcoming week brings a key U.S. employment report that could shape the Fed's interest rate decisions. The S&P 500 is near record highs, up over 25% this year, fueled by expectations of continued Fed rate cuts after a 75 basis point reduction in 2024. Strong jobs data may challenge these expectations, making this report critical for investors tracking market trends. November has been a blockbuster month for U.S. stocks, with the S&P 500 and Bitcoin hitting record highs. This surge follows the Republican red sweep on November 5, boosting optimism around President-elect Trump's pro-business agenda, including corporate tax cuts and deregulation. While concerns about tariffs remain, markets see them as part of early negotiations, fueling strong investor confidence. Global markets rallied Friday, with Wall Street ending November on a high note as the S&P 500 and Dow posted their biggest monthly gains of the year. Optimism over post-election growth and pro-business policies fueled the surge. U.S. trading was light after Thanksgiving, with most month-end adjustments made earlier. Meanwhile, the dollar eased as Japan's inflation data raised expectations for a rate hike. Tesla's stock rose 1.8% on Friday after Wedbush analyst Dan Ives projected a $1 trillion opportunity in AI and autonomous driving for the company. Ives noted that CEO Elon Musk's significant influence in President-elect Donald Trump's administration could expedite the development of self-driving vehicle regulations, benefiting Tesla's autonomous initiatives. The S&P 500 achieved 52 record-closing highs in 2024, averaging more than one per week. However, the year wasn't without setbacks, including an 8.5% dip from peak to trough in August. Deutsche Bank macro strategist Henry Allen notes that markets have shown resilience, but warns of three key risks that could drive fresh sell-offs. The August slump triggered by weak jobs data, disappointing tech earnings, and unwinding yen carry trades after a Bank of Japan rate hike underscores the vulnerability of risk assets to economic downturns. Now let's review some data. I want to show you guys. The S&P 500 index achieved its best monthly performance in a year, closing November nearly 6% higher, a gain surpassing the combined total of the previous 4 months. This marks the largest monthly increase since the 9% rise in November 2023, which initiated a historic market run. Since the low in October 2023, the S&P 500 has surged approximately 47% and is on track for a second consecutive year of over 25% annual returns. Additionally, the index's market capitalization has exceeded $50 trillion for the first time, underscoring the remarkable strength of the current market. The S&P 500 is experiencing a historic rally, poised for 2 consecutive years of over 20% gains, a feat not seen since 1998. After a 26.3% return in 2023, the index is up 25.6% year-to-date in 2024, totaling a 58% surge since early 2023. Historically, when the S&P 500 has achieved back-to-back 20% gains, the following year has been positive in 6 out of 8 instances, with declines only in 1977 and 2000. This exceptional performance has propelled the index's market capitalization above $50 trillion for the first time, underscoring the market's remarkable strength. Bitcoin's demand has surged, with CME Bitcoin futures open interest surpassing 40,000 contracts for the first time, doubling since the year's start. At its November 2021 peak, open interest was around 17,000 contracts, approximately 58% lower. Bitcoin's market cap has also reached a record $1.94 trillion, reflecting increased investor interest. US stocks currently represent 73% of the MSCI World Index, marking the highest single-country weighting in its history. This dominance indicates a significant concentration of global capital in US equities, potentially leaving other markets underfunded. Historically, market leadership has undergone secular shifts. For instance, in 1989, Japan's stock market briefly surpassed the US in global share, only to decline thereafter. Such precedents suggest that the current US dominance may not be permanent. Investors should consider the potential for capital to flow back into overlooked markets, as diversification can mitigate risks associated with overexposure to a single region. Maintaining a globally diversified portfolio may help navigate future shifts in market leadership. The Federal Reserve may soon face a policy dilemma. With core personal consumption expenditures, PCE, inflation at 2.8%, recent data suggests consumer prices are stabilizing. Historically, such patterns have preceded a second wave of inflation. The Fed's ability to counter this potential resurgence is constrained. Further interest rate hikes could exacerbate the government's substantial debt burden. This scenario poses bearish implications for the US dollar. Compounding this outlook, President-elect Donald Trump has advocated for a weaker dollar to boost exports. However, his proposed tariffs and fiscal policies may inadvertently strengthen the currency, creating a complex policy environment. Investors should monitor these developments closely, as they could significantly impact currency markets and broader economic conditions. Now let's review the S&P 500 heat map. Microsoft gained 2.5%. Apple surged 3.85%. Amazon climbed 4.79%. Eli Lilly soared 6%. Tesla and Meta both rose nearly 2%. Nasdaq was down 5.75%. The market showed significant strength across key sectors, with some tech giants leading the charge despite broader index declines. The CNN Fear and Greed Index currently stands at 66, indicating a sentiment of greed in the market. This index measures investor emotions on a scale from 0, extreme fear, to 100, extreme greed, with readings above 50 signaling greed. Predicting whether the index will reach extreme greed, a reading above 75, next week, involves considering various market factors, including economic data releases, corporate earnings, and geopolitical events. While current trends suggest positive investor sentiment, unforeseen developments can rapidly alter market dynamics. Here are the notable earnings reports scheduled for the week of December 2nd, 2024. Monday, December 2nd, Salesforce, CRM. The cloud-based software company is expected to report a 16% increase in adjusted EPS and 7% revenue growth. Tuesday, December 3rd, Hewlett-Packard Enterprise, HPE. Investors will look for updates on the company's transition to a services-oriented model. Zscaler, ZS. The cybersecurity firm's performance will be under scrutiny amid growing industry demand. Wednesday, December 4th, Okta. Analysts anticipate insights into the company's identity management solutions and market expansion. Thursday, December 5th, Lululemon Athletica, Lulu. The athletic apparel retailer's earnings will reflect consumer spending trends during the holiday season. Friday, December 6th, Viva Systems, Vive. The focus will be on the company's performance in the life sciences software sector. Now let's review the key events for the upcoming week. Monday, ISM Manufacturing Index. Tuesday, JOLTS job openings. Wednesday, ADP non-farm employment and Fed Chair, Powell speaking. Thursday, initial jobless claims. Friday, non-farm payrolls. All right, folks, that's a wrap for this video. If you enjoyed the content, make sure to like and subscribe. Have questions or thoughts? Drop them in the comments and I'll get back to you as soon as I can. Thanks for watching, and I'll see you in the next one. Take care.